so happy to have you all here in our new building. Marissa, when did we move into this building?
I think it was maybe April.
Okay, April. So it's been a few months. By the way, this is Marissa Coleman. She's my internal sales partner on the sales desk. So we're just absolutely thrilled to have you here, and welcome to our very first client meeting for myself in this office. So thank you all. Great. And we've got a full slate of portfolio managers to join us to talk through not only the retail mutual fund side, but also a little bit on the lifetime platform as well. So again, we are super excited. You know, you think about who we are at Invesco, we're a global firm. We've got offices all around the world, but we are headquartered here in Atlanta. We currently manage $1.5 trillion, trillion with a T. That makes us one of the largest asset managers in the world. But a big thing of what we want to do as a partner to you all is really our value proposition. And we say that we want to deliver to you all, our partners, what we call our total client experience. So in every interaction that myself or Marissa has with you to help you in your securities business, we want to help you connect with your clients, enhance your business, and optimize your portfolio. That's what we call is the total client experience, or for short, the total CX. Today, we're going to hit on a few of these different pillars of what is our value proposition, and I'm so excited that we can showcase these resources to you all. Let's get this party started. So first and foremost, our first speaker, you all know him very, very well, is our senior client portfolio manager, Sergio Marcelli, of our equity income fund. Sergio, next to you.
Good to always see a lot of familiar faces in the audience, so I appreciate everybody taking time out of their Friday to come hear me speak and hear the rest of us. And also, thank you all for everything you do. You know, Primerica is one of our top clients, and we can't do what we do without you. So, from my team, thank you all for everything that you do as well.
Awesome stuff. Thanks, Sergio. So let's start off with a couple questions here. Maybe just the first question, Sergio. You know, you think about equity income fund. It's one of our oldest mutual funds. It goes back to the 1960s. And we always talk about the process that you and the team, implement, and it's been consistent for many, many years. Can you speak to that process of the equity income fund?
Absolutely, Matt. And to Matt's point, the fund has been around since 1960. And while that's just amazing in itself to have that type of track record going all the way back to 1960, and we can showcase all different types of market environments the portfolio's been in. What I like to emphasize is that our philosophy and process, the way we actually manage the portfolio, has been in place since 1990. So we're on over 30 years of utilizing the same philosophy and process within that portfolio. And so when you're showcasing the portfolio to your clients, you can go back to 1990 and know that we have not changed how we manage that portfolio since 1990. There's been continuity in terms of the lead portfolio manager going back to 1990. So the lead manager who ran the fund in 1990, he ran it all the way to 2008. And then when he retired, his associate, who he hired back in 2003, took over as lead manager in 2008, ran the portfolio all the way to 2019. Since then, the managers that he hired, he trained on the same philosophy and process. They joined the teams in 2012 and 2016 respectively. They've now been running the portfolio since 2019. So it's just something that we believe in terms of our philosophy and process. And I think because we have a philosophy and process that we believe in and we stick to, we've been able to deliver performance, consistent performance throughout all those different type of time periods, different market events, and we're disciplined, right? So we're patient investors. We try to remove the emotion of investing, right? This year, people got very emotional in the first quarter, right? Everybody remember what happened with the regional banks. Think of Silicon Valley Bank. People were worried, oh, there's going to be a financial contagion. In those environments, clients and investors can get emotional, right? So we have a process in place that we try to remove that emotion from investing and stick to the process and find new opportunities when those type of events happen. And I think that is really what helps us in terms of managing the portfolio.
Yeah, absolutely. Let's go. You talked about a little bit in terms of being consistent in terms of performance, and you can go back and look, and since 1960, And again, we talked about earlier, process may have been a little different, but consistency, average about 10% per year since 1960. I guess walk us through how does that happen? In terms of history and how does that process come to deliver those types of results?
Right, absolutely. So first off, for those of you that are familiar, but maybe not as familiar with the equity, but it's a balanced portfolio, right? And so you can see this chart up here right now, and we are investing in 3 different types of asset classes, right? So we have an equity sleeve of the portfolio. We're typically going to own somewhere between 60 to 65% in common stocks. Those common stocks that we're investing in are large cap companies, but we're investing in value companies, or companies that we think are undervalued relative to where the stock market is right now. Then we also have a fixed income sleeve, and that fixed income sleeve has ranged historically between 15 to 25%. We're hovering a little bit over 20 right now. That fixed income portfolio is the anchor for the income in this portfolio, right? It's a conservative fixed income portfolio that's made up of treasuries, government securities, and hybrid corporate bonds. So it's really there to provide income for the portfolio. And then the third sleeve, which I think really differentiates us, is the convertible bond sleeve. And the convertible bonds are simply bonds that have the ability to convert into common stock at some point in the future. So you end up with 2 asset classes in one security. And why is that a benefit? Because you get income off of that bond, and then you have the ability to get equity participation out of that bond at some point in the future. And I think that has really helped distinguish us and help deviate or create something that other equity balanced portfolios don't utilize. And so from that standpoint, we stick to this process in terms of the allocation, right? And that, I think, has helped deliver the consistency within this portfolio, as well as stock selection, right? We're investing in these large, undervalued companies that we think over time will appreciate once they make improvements to their companies and there's some type of positive change or catalyst that occurs.
The reason why it's called the all-weather portfolio, as Sergio mentioned, right, is it owns those different types of investments that are packaged into one strategy. So you got the stocks for the upside, you got the bonds for the downside, and then you got convertibles, which we'll talk about a little bit, which are kind of like the special teams that do really well in some of those flat market environments. Maybe let's get into some of the top, talking points about the market. 2022, think about the volatility and what happened. Even more so in 2023, we've seen it kind of bounce around. What do you guys see right now with the market? What's going on?
Yeah, so it's, of course, every year we say, can't get any crazier than the year before, but we find a way to make things more crazier each year, right? We first had, 2020 with COVID, right? And then, you start going into 2021, things get a little chaotic, and then things were going to be a little bit more calmer, and then all of a sudden, Ukraine, Russia, end up in war in 2022. So there's just been a lot of chaos going on in the markets that create a lot of volatility in the marketplace, right? And so what we do in these environments is, again, fall back on the process. And so what we try to do is take advantage of these market dislocations that happen. And so, to Matt, your point, I mentioned the first quarter of this year, in 2023, the regional banks. We've had a lot of fear in the market, and we had a lot of stocks being sold off during that time period. What did we do in that time period? We started looking for new opportunities. Now, what we did, in particular, in the financial space, because all financials were definitely, there was panic out there, right? So you look at our top holdings right now, our number 1 holding is Wells Fargo. It's in the news today. They just reported earnings. They did a phenomenal job. I think pre-market, the stock was up over 3% on the announcement of their earnings. But in those environments with financials and what was going on with the regional banks, what do depositors do? Well, they take their money out of those regional banks and move it to stronger banks, right? So think of Wells Fargo, think of Bank of America. When all those depositors were scared and taking their money out of the small banks, that money needs to go somewhere. And they're going to go to the bigger banks. It's what happens. The big get bigger, they get more profitable, and that's what we saw, and that's what we took advantage of. But during that time period, there was fear. Financials were going down during that time period, and so we were looking at those names and adding them. Prior to that, though, in 2022, what we did when the market sold off dramatically, if you guys recall, growth stocks in particular. We had for the longest time what was called the FANG stocks: Facebook, Apple, Amazon, Netflix, Google, throwing Microsoft in there as well, right? Although we can't call it Thing anymore because Facebook isn't Facebook anymore, it's Meta, right? And Google is Alphabet. So I don't know what kind of acronym we can come up with now with the new names on those. But the point being is those stocks drove the stock market higher up until 2022 for the longest time period, right? For the last, up until 2022, you look back the last 4 years prior to 2022, FANGs is what really drove the overall stock market. Well, in 2022, what ended up happening, a lot of those names sold off dramatically. It started back in 2021 and into 2022. So as a value manager, we hadn't been able to own those names for quite a while. And people always ask me, oh, why don't you want to own Meta? And why don't you want to own Amazon? It's like, they're too expensive, right? But I tell people, I love to own growth companies. I want to own growth companies. I just don't want to overpay for those growth companies. And so what ended up happening in 2022, that created an opportunity for investors like us to finally step in and start buying those companies because they went on sale. So we bought Amazon, we bought Meta, and so we took that opportunity to start buying some of those names that we couldn't own for a while, and we started to get the benefit of owning those names as the market started to recover.
And I'm putting it in pocket, I think Meta, you said when you bought it, what did we see return-wise when you guys bought it?
Yeah, it's been amazing. So, Meta had a lot of problems. If you recall, they were spending like drunken sailors, right? Because they felt their company was just growing and growing and growing, and all of a sudden their CEO, Mark Zuckerberg, said, you know what, let's create this meta universe, right? Think that virtual reality and those Oculus glasses that people wear on their faces and try to do things in the meta world, I guess it's called. But he spent way overspent on that. And so investors were not really happy with that. And so the stock sold off dramatically. And there was a lot of pressure getting put on that company to do something different. Well, they did. And once that stock sold off dramatically, we started to buy the name. And lo and behold, he came out and said, okay, we're going to start cutting. So they started doing layoffs. And they stopped investing that high amount of money they were investing in Meta. What happens? The stock goes up. So year to date, the stock's up over almost, I think it's up over 100% now, but I could be wrong. But it's been up over 100% since we bought it. So it just gives you perspective on when you can find these type of growth companies that go on sale, you can definitely make a lot of profits on them. And then recently, the more recent announcement from Meta is they're going to go up against Twitter now through this new Thread. And Thread has had the largest amount of users join within, I think it's been over a week, and it's just a massive amount of people using Thread now. So it's a great opportunity, but as a value investor, we were finally able to buy a name like that because of it being sold off back in 2021, 2022.
Good companies,
Yeah.
catalyst for change,
Yeah.
they're out of whack.
Yeah.
And maybe let's go back. So again, equity income, all weather, stocks, bonds, convertible bonds. The convertible piece is usually a piece that maybe some folks aren't as familiar with.
Right.
We call it the special teams, right? The secret sauce, if you will. Can you kind of walk us through a little bit more of convertibles and how they
Sure. Yeah. So it's just not a security that's used very often in that clients are aware of, right? But it's simply a bond. That's all it is. It's a bond. What happens is a lot of these companies they want access to capital sometimes fairly quickly. Part of that is to refinance debt, maybe use money for an acquisition. And so if they want to issue new stock or they want to issue a bond, it's a process. It takes a while. However, with a convertible bond, they can issue a convertible within 24 hours because it only is being offered to qualified institutional buyers. And so it's a very easy way for corporations to get access to capital in a very quick manner. And so what happens is when they do this, the amount of capital they're asking for can range anywhere from 50 million to over $1 billion. Most of the time, these companies are asking somewhere in the range of 100 to 500 million in offering. So they're offering I'm using the example, $500 million of convertible bonds. So they'll sell those convertible bonds to institutional buyers like us. During that time, we get a prospectus from them, and it states what the convertible bond is going to be offering in terms of a yield, and then also when it will convert into common stock. And so we are able to understand what kind of income we're going to get off this convertible bond, as well as when the maturity is going to be and when that maturity date will be. And when that maturity date comes, you have optionality, typically have optionality to convert it into common stocks or just take your money back. So it's like a regular bond. If you buy it at par and you hold it to maturity, you're going to get your bond. You're going to get your full money back. Now, the price will fluctuate based on what rates are doing and also based on what the company's doing as well over that time period. So what we typically are looking for, we will buy these convertibles sometimes at the offering, but sometimes we'll buy them in the open market. If we can buy these convertible markets in the open market that are trading at a discount to their par value, that's pretty attractive to us. Why? Because you're buying it at a cheaper price. The yield on it is probably attractive, so you're going to get that income. And then if you hold it to maturity, you have that opportunity to get back to, the discount between what par value is and what the current price is. And so we just find those, not many of our competitors utilize them, and so we feel like it's been a big advantage for us to utilize them since 1990. We're very well versed in knowing these things. We understand how they work, and so we try to take advantage of them when we see opportunities out there.
So, all right, let's go back to just the overall, think about equity income, the all-weather portfolio. Where does it fit in?
Yeah.
From your perspective in a portfolio, where does it fit in?
Definitely. So I would say equity and income, and for clients that you're looking to get involved in the equity markets, I understand, especially clients that have never had a taste of investing in equities. This portfolio is what I call a foundation for equity investing, right? It gets clients' feet wet, right? They want to stick their toe in the water because they may feel a little bit nervous about stock market and how it's doing. This is the type of portfolio that gets them into the equity market, but without doing that 100% exposure to the equity market. And so I view it as, and I use the analogy of building a house, right? When you build a house, the first thing you need, and you need to make sure it works and it's strong, is your foundation of that house. Because if you don't have a strong foundation, you start getting cracks in it. What equity and income does, it helps create that foundation because you're getting a mix of common stocks and fixed income in the portfolio that helps reduce the volatility of just owning a pure equity in the portfolio. We have charts that we can provide that shows the 20-year return of equity and income versus the Russell 1000 Value Index, which is an equity-only index. And you're basically getting similar returns to that benchmark, but with less volatility, less risk. And so essentially, your client is going to have a smoother ride if they hold this portfolio over a long period of time versus just owning a 100% equity portfolio. So think of a roller coaster. You have these ups and downs. The equity income kind of creates a smoother ride for clients that are looking to get involved in equity investing.
Foundational piece that is equity investing. Great position. Let's go back to the interesting stuff. Right? We've kind of talked about that a little bit already, but I know people love the stock stories.
Of course.
You give us some more kind of top holdings and maybe those that you can add into and kind of the ideas.
Absolutely, yeah. So another one, we've got involved in Amazon here over the last year and a half. Amazon's an interesting company. Everybody uses it, right? The clients use it, they know it. Anyone here with Amazon Prime, all of that stuff. Now,
Prime Day is still going on.
it's Prime Day, right? And so, this company, when we look at the other types of growth companies out there, like Microsoft and Apple, those companies over the last 2.5 years have just grown by leaps and bounds. When we look at Amazon in terms of their stock price, it hasn't grown as much as like an Apple or a Microsoft. And people, when you think of Amazon, most people think of Amazon.com and shopping online. But they also have another business, it's called AWS, which is Amazon Web Services. And that's really where they make the bulk of their money. But yet investors really have not, in our view, placed a premium on that yet. But they are at the forefront. People talk about Apple and Microsoft with AI. Amazon is right there with them with the AI as well. And yet investors just have not placed a high premium on Amazon versus like a Microsoft or a Apple. And so we think there's a very strong opportunity there. And what people all understand about Amazon, what they have done to our society is what everyone wants, right? They've given your time back. Your time back, right? That's the most precious thing you have, and that's what Amazon gives you. You You don't have to go to the store anymore. Just in, your package is at the door, right? And so there's a premium for that, and I think people will begin to start focusing more on that. And I think as AWS grows, their business continues to grow. For us, we think it's a pretty attractive opportunity here.
And again, I think you talk about equity income, typically, as Sergio said, it's more on the value side of
Right.
stocks. And yet, there's two that you just mentioned that he highlighted, both Facebook, Meta, and Amazon,
Yeah.
which historically have been kind of always siloed in that growth. So again, it goes back to that process of finding good quality companies that have a catalyst for change and doing so at the right price. As we kind of wrap up, long-term outlook of what you all see, just give us kind of a recap of what's going on right now.
Yeah, absolutely. So I think we're still waiting on a recession. Has that happened yet? It's the most talked about thing that has never occurred. And so I think you're seeing here in the U.S., I think the economy is starting to strengthen. You're seeing inflation starting to come down. There's some blue shoots that are beginning to pop up. And so in our view, I think we're probably, and this is not, this is Captain Obvious, of course, I think we're closer to the end in terms of the Fed raising rates here. Probably going to see them raise rates again, even though their inflation numbers are coming down. I just don't think they're going to keep going as aggressive as they have been here over the last few months. And so why is that important? Because we finally do get to a point where rates are kind of at a level where they feel comfortable, and then we start to see continued economic improvement. All of a sudden, they might be talk of next year potentially easing. And if that happens, you can get a continued strong economy, you can continue to move even up from here. And what you've seen here over the last 6 months, look at what's going on in the stock market. It's been a very, we're kind of packed, it's deja vu back with what happened from 2016 to 2019, almost 2020. It's a very narrow market, right? You look at the Russell 1000 growth index, it's basically measuring growth stocks at the large cap level versus the Russell 1000 value. The Russell 1000 growth index is up over 25%. My colleague Greg Holland's going to come in here and tout how great growth is doing, right? And it is doing great. They're up 25% for the year. The S&P 500 is up over 15% for the year. The Russell 1000 values, a measure of that large value stock, is up about 5% for the year. What's been driving the market? It's been Apple, it's been Microsoft, it's been some of these tech companies and this AI craze that's going on right now. So this market has not lifted all boats yet. It's been very concentrated in certain areas. And so why we get excited is because value's been underperforming here for the last 6 months, and they have not been able to participate in this market. So we are in the areas, and I've talked about some of these tech companies, but we are in the areas that really haven't participated to the full extent. We still have a decent weight in energy, we still have a decent weight in financials, as well as the industrial space. And so we think if we do get into a more economic recovery mode, you're going to see those areas of the market really begin to start taking off. And we're now in an environment where we're back to what I believe is normalized interest rates, right? For the last 20 years, we've been operating in close to 0% interest rates. We are now back to what we should be a more normalized environment. And so all of a sudden, a lot of these companies that were able to build their businesses over the last 20 years on low interest rates, all of a sudden, the valuation of those companies needs to be rethought because their cost of capital is now a little bit more expensive. They want to borrow money. They're not borrowing it at 1 or 2%. They're borrowing it at a higher rate now, and that's going to affect their profitability, their margins, all of that. And so we believe that value investing in this type of environment over time should do very well. So we're actually pretty excited. That's not to say that there's not going to be continued volatility in the market. I just don't ever see, well, I can't say, I never say never, but here over the current time period we're in, you just can't see there not being volatility. We're in this environment where information is flowing so rapidly, a lot of things happening globally, and of course, we're getting ready to go into 2024, and 2024, we all know what that is. It's silly season, right? It's already starting, right? We're going to be in an election next year, right? So it's just, we're getting into this environment where it's going to get a little bit nuttier, and there's going to be volatility and just
Yeah, Sergio, can you talk a little bit about what your team's strategy is when you guys are selecting the right selection of funds on how you all allocate it? What goes into it? Is it the balance sheets of the companies? What is kind of that?
Good question. Yeah, in terms of like, Kendrick was asking, what goes into deciding what stocks are going to go into the portfolio, right? So, I talked at the high level of our process. So we start out, what I call value investors start out. We start out with a universe of names that we're looking at. We're typically looking at names in the Russell 1000 index, which is a measure of the top 1,000 U.S. companies. We also have exposure and can invest in some international names. So from there, we run screens, right? We run screens. Think of it as a funnel. We're trying to funnel down to get it down to a more manageable level of names that we can focus on. And so we run different valuation screens to get that down to a more manageable level. So we're looking for companies that we believe are undervalued, under-earning, and unloved. And so the undervalued part is the screening process. So we look, when I talk about valuation, we look at things that such as price to earnings, price to book, price to sales. Those are all financial metrics that determine if a stock is undervalued or overvalued. So what we do is we run that depending on what sectors we're looking at. So we may look at a price to earnings, we may look at a price to sales or a price to book. It just depends on which sector we're looking at. That helps us get down the number of names further from there. Then we look at what's called under-earning. And we want to find companies that are earning less than what they've historically earned over time. So by doing that, we look at their operating margins, how profitable they are, and their return on equity or return on capital. We want to find companies that are low returns right now. Because if they're low returns, they probably are operating in a period of disappointment, and there's an opportunity for things to turn around. And then the final thing is unloved. And this is our contrarian indicator for us. So when I mean unloved, think of the Wall Street analysts, right? There are analysts out there that work for like a Morgan Stanley, Goldman Sachs, UBS, you name whatever, and they're providing research, right? And those analysts, you see them on CNBC, I've got a strong buy or I've got a strong sell, I've got a hold on the stock, whatever they put. We want to find those companies where the majority of those sell-side analysts have a negative view on the company, with the belief that if most of the analysts don't like the stock, more often than not, that news is already priced in. That negative news has been priced in. So we want to find those companies that people don't like. But what we want to see is them revising their earnings estimates up. So they're not making a recommendation to buy the name, but they're all of a sudden you're seeing them say, oh, I think the company's going to earn more money next year. Well, that's information here. It's telling us something's going on in this company that maybe looks attractive. And so that'll get us down to a more manageable level. And then from there, we do the fundamental analysis. That's when we sit down and look at the company's financial statements, the balance sheet, the cash flow. We meet with the company management team. We're fortunate being down in Houston. We actually get some of the CEOs and CFOs. They'll come to our office and we can sit across the table from them and just have a one-on-one conversation with them to help understand how they're running their businesses and if we think they're competent, right? And so from that standpoint, that's how we determine what name's going to come in the portfolio. The final thing is, as Matt had talked about, we look for catalysts, some positive type of change that's happening. We look for fundamental changes, sector changes, or changes in management. And those are one of those three catalysts is what we're looking for before we make an investment.
Yeah. Are there any things that you see that may say, hey, this is somebody that needs to be out of our portfolio before they become rich?
Yeah, that's a good question. So from our standpoint, when we buy names in the portfolio, we do set price targets to them. So we base our names right. We think when this stock is priced here, we think it needs to be priced here. And as it gets closer to that price, we start to sell that name. And what we're trying to do is find another name that we think has better risk reward opportunities. That being said, we're going into the silly season, as I mentioned. There are things that definitely can play out in there, but from our perspective, we are indifferent in terms of who's in charge, right? We just need to know who's in charge, right? We want to eliminate the uncertainty because once you know who's in charge, then you understand the policies that are going to be put in place, and then the companies will adjust those policies, adjust to those policies and make changes. They're going to find a way to become profitable or make money regardless of what type of environment they're in. So from that perspective, we do pay attention to that.
I was going to piggyback on that. What names have you sold recently and why? And
Yes, great question. So we have been, over the last year and a half, we've reduced our exposure to some of the financial names. We've been paring back some of the financial exposure as rates have moved up. Financials have done, initially they were doing well. Right now, all of a sudden, they basically, as rates become too high, it starts to become a little bit of a detriment to them. So there's been some reduction in our exposure in financials, plus with everything that happened in the regional banks. We did own a couple of regional banks, and we reassessed how much exposure we want to them. The other area that we've also been kind of reducing some of our exposure to is the consumer discretionary area. I think it's portfolio booking.com is a name that we did extremely well in. This was a name we got involved with back in 2020, right, when COVID hit. Of course, everybody panicked, right? And nobody wanted to travel anymore. The stock like a booking went down dramatically, right? Because everyone's like, no one's ever going to travel anymore. Well, again, you remove the emotion out of it. Travel is a secular growth industry. It's going to grow. It's going to continue to grow. I mean, yesterday Delta here in Atlanta reported earnings, had phenomenal earnings. So we did extremely well with booking, and we took our profits from the name like that.
Do you see this gap between large growth and large value? Do you see that continuing to widen temporarily and to work itself up?
It's hard to say. I think we are getting to a point here, though, where the dispersion is pretty wide.
Yep.
And at some point, there's got to be a reversion to the mean. I can't tell you when that's going to be, but I do think the AI craze kind of helped fuel a lot of this stuff here over the last few months. We're in the middle of earnings season, so all these companies are about to start reporting, and it's going to be interesting to see what they do, because I think they're probably going to show that they've done very well this last quarter. It's the guidance that they give forward, right? Like in terms of, hey, we think we're going to even do better, and if they do, well, then we could see more dispersion. But if they come in a little bit more tame about, well, we need to tamper down expectations about this stuff, I think you could potentially see that reversion start happening. Just to let you and your clients know, we eat our own cooking on this stuff too. And so we are investing right alongside you and the investors. And I know it's probably not the most exciting document to show your clients, but there's a document called the Statement of Additional Information, SAI. And in there, it's a very big document. It's online. You can go online. And I always tell people, go online, you can download the PDF, and you can do a search. You can type my name in. During that document search, you can type in any other portfolio manager thing. It'll take you to the page that will show you how much ownership we have in the portfolio. It gives a dollar range of what our investments are. So you can show that to your clients saying, look, these portfolio managers are investing right alongside with you as well, just to give them even more confidence that we're there as well. We're investing right alongside you and your clients.
I think it's a great piece that's super timely right now. This is the Invesco Equity Income Fund Investable Ideas piece. I think there's something like, $5 trillion in money markets right now. Probably a whole heck of a lot of more billions of dollars in CDs. Right, CDs, what's the rate that you can get on CDs right now? 5, right? People are jumping to that, right? This is a piece, whether you've been in the business just a couple of years or a couple of weeks, or you've been in the business for 30 plus years. This is a great piece to really highlight how you can talk to someone about the importance of investing versus just saving. And this piece right here, I know some of you don't have it, but what this piece does is trying to really talk about the differences between the equity income fund and the benefits that it provides versus the benefits of what CDs provide. There's kind of a 2 columns in the front which talk about here's what equity income does, here's what CDs do. But what's really cool is in the inside part of this, we've got 2 scenarios where we match up the Invesco Equity Income Fund versus CDs to walk through different withdrawal scenarios. So instead of just locking your money up in a safety investment like a CD, what if, Mr. and Mrs. Client, Mr. and Mrs. Prospect, what if we took a portion of that money, we took that money and invested in a strategy like the Invesco Equity Income Fund, and we took out withdrawals to match the type of income that you get on CDs.
So the first scenario is basically running a side-by-side hypothetical illustration of the equity income fund versus CDs, putting in $100,000 back in 2003. And what you're doing is matching your withdrawal that you take out of equity income every single year to match what the annual CD rate is. So essentially, you can tell people, hey, let's just match what you can get in CDs every single year, but let's make sure we keep your principal invested in the market. So $100,000 in the Invesco Equity Income Fund, $100,000 in CDs, you match the income, and what you see over a 20-year period is at the bottom, you've taken out the same amount of money, it's roughly $35,000. You've taken out the same amount of money that you've gotten on the CDs in terms of income. But look what that $100,000 has turned into. Instead of just being the static $100,000 you had in CDs, instead you have left over at the end of 2022, $342,000. So that's the first scenario. The second scenario is more of a fixed withdrawal plan, where you do the same thing going back 20 years. You put $100,000 into the equity income fund, you put $100,000 into CDs, but on the Invesco Equity Income Fund, you take out a withdrawal of 4.5% per year, and you up it every single year to match historical inflation of 3%. So your first year, you're taking out $4,500, and you'll see in that far right column, your income is going up every single year. So over that 20-year period, you've taken out $120,000, and you still got left over $187,000. If you would have matched that on CDs, if you would have taken that type of income, you would have eaten away at your principal, and at the ending amount, 20 years later, CDs you only have like $4,200. This is a piece that you can use to really have that conversation in regards to investing money, putting it in the market, and seeing long-term compounding growth versus playing it safe. I always tell people, you work hard for your money, right? Shouldn't your money work hard for you?
So I've been unofficially working with the fund since 1999, officially been on the fund since 2003. Been with the firm since 95. Back in Camp in America capital. I knew Lowell Jackson.
Yeah. Thanks for being here, Sergio. Appreciate it. The stock market dropped 38% from 1972 to 1974. So they put $10,000 in, and just 2 years later, they were each left with $6,950. So now, they've got a decision to make. What do? The first family, the Stevens, this is kind of tough to see, but it's in the equity income brochure piece, decided to play it safe. So when their money dropped, and it went from $10,000 to $6,950, they decided to play it safe, and they decided to sell. So they took their $6,950 and put it into a fixed rate investment, kind of like a CD, that from 1974 through 2021 averaged about 2.2% per year. So that $6,950 was eventually worth $28,000 because they played it safe and because they sold it. The Ryans, on the other hand, right, they at least got halfway there. They decided to stay put. They said, you know what? The market's going to come back. We know we're invested in a good quality investment, that is the Invesco Equity Income Fund. We're going to keep our $6,950 in this investment, and we're going to watch it grow over time. From 1974 through 2021, that investment is eventually worth just over $1.1 million. Think about that, the difference between $1.1 million and $28,000 because they stayed put, right? But how about the last family, the Andrews? They took it a step further. With guidance from their Primerica advisor, they decided, you know what? We're going to invest more. So not only did we keep that $6,950 in the Invesco Equity Income Fund, but we also wanted to set up a pack of $100 per month to automatically invest every single month into the Invesco Equity Income Fund. From 1974 through 2021, eventually their portfolio was worth $2.4 billion. Folks, this is the story that people should be telling.
coming off the backs of 2022, right, where the market was down 18%, 20%, depending on which, market you look at, what did most people do? They decided to play it safe, right? So what did they miss out on? They missed out on the recovery. This is a story that we need to continue to tell people why it's so important not only to stay invested, but to keep investing every single month. So this is a great story that you can tell it's inside of the Invesco Equity brochure. The other piece that I want to highlight, this is probably our most popular piece to use with clients. This is a piece that is client approved. It's called our Navigating Volatility Deck. This is a great piece. It's about, I think, 12 or so slides that can really help people stay invested and to really understand historical market perspectives. If you're looking for client material to really talk about market history, right, Navigating Volatility is the piece. Email me after this meeting that you want to see the Navigating Volatility Deck, because it's going to give you the slides that you need to overcome the common obstacles that you hear from not only clients, but prospective clients. A big one, right, we can talk about the investor return gap, what markets return versus what the average investor returns. That's a great slide that's in here. The other one, which is probably one of my favorites, is the tale of the 10 best days. And this is such a good slide. I know I see a couple people kind of nodding their heads on this one, right? This is a great slide that you can use to really convince people that, hey, the reason why we want to be in the market is because we need to capture the best days that the market can offer. So on the left-hand side here, again, this is a story of over a 30-year period, from 1992 through 2022. If you put $100,000 into the stock market, as measured by the S&P 500, if you put $100,000 in, and let's say in the far left, you just stay fully invested. You put $100,000 in, and you don't touch it, okay? $100,000 over a 30-year period in the U.S. stock market would have averaged 9.6% per year, and the ending value would have been $1.5 million. That's if you just stay fully invested in U.S. stocks. But here's the thing. What happens over that 30-year period if the client decides that, you know what, they're going to take their money out for a couple days here, maybe a couple days there. Let's say they miss some of the best days that the market offers. In that 30-year period, if you miss the 10 best days that the market offers, instead of earning 9.6% per year, by just missing the 10 best days, 10 days, you earn 6.8% per year. Instead of having the 1.5 million, you only had $725,000. 10 days. 10 days. Trivia question today. Roughly, how many stock market trading days are in any calendar year?
252.
252. You guys are good. I've probably said this before a couple of times. To make the math easy, let's just say 250. 250 trading days in a year. What's 250 times 30? 7,500? 7,500 trading days over a 30-year period, and if you miss just the 10 best days. That's put into perspective. Okay? That same story is exasperated when you miss the 20, the 30, the 40, the 50 best days. The challenge is we don't know when those best days happen, and oftentimes those best days come very, very close to some of the worst days. On the right-hand side of the chart, we've taken a step further to say over that same 30-year period, right? What if we just look at the 30 best days over that 30-year period? And what we found is of those 30 best days, 80% of them happened in the middle of the bear market, so the worst times to invest. You go back to 2000 and 2002 in the tech wreck, 20% of the market's best days over the last 30 years happened in the tech wreck. Look at the financial crisis, 07, 09, 40% of the market's best days happened in the middle of the financial crisis. It's highlighted in the dark blue. That's what we lived through in 2020. 20% of the market's best days over the last 30 years happened at the onset of the COVID-19 pandemic. They had days when the market was up 4.5, just over 5, up 6, up 7, up 9. Think about if clients missed some of those up days, right? The 8 or 9% days because they decided to get out of the market. You can have have a huge impact in terms of your overall portfolio.
Just a couple more slides that I want to run through here. This is a good one too, that I think really can help you understand market perspective and market history. This is a slide that we call the volatility does not equal loss unless you sell. What this does is just really show you, throughout market history, what types of environments we have experienced. So what we're trying to show you is a lot of boxes here. But on the navy blue boxes, which most of them are up top there, what we're showing you is the calendar year return of the U.S. stock market as measured by the S&P 500 going back every year to 1989. So it really can be an understanding of what we've experienced in market history. So every calendar year back to 1989, the navy blue box, which you can't see right now, but that's okay. The navy blue box represents what the market returned in that percent. What do you notice about those navy blue boxes? Majority of the time they're positive, right? Only a handful of times do we see those navy blue boxes that are in the negative territory. On average, if you would look at the median return across the top there, it'd be about 14% per year. That's what we've averaged in the S&P 500 going back to 1989. The light blue represents the opposite end of the equation, if you will. Some would say it's the price you pay to get that 14% return. The price that you pay to get the 14% return is the volatility along the way, or the fluctuation of the market along the way, because the lighter blue boxes represent the largest drop that the market experiences every calendar year going back to 1989. So for example, in 1989, the market returned 32% for the year. But at some point in time, the market dropped 8%. And if you average that across or look at the median since 1989, on average, the market drops about 10% per year. So this is a great piece to fall back on when we get in some of these volatile times, knowing throughout history, right? We've averaged about 14% per year in the U.S. stock market since the late 80s. But to get to that 14%, you've had to withstand about a 10% drop every single year. Some years it's more, some years it's less, but it gives you great perspective in terms of understanding what the market has done throughout the years. Last thing that I'm going to share, last slide. We've talked about it. There's been tons and tons of money that has gone into the safe investments, the money markets or the CDs, if you will. We've actually ran some stats here, and bank deposits are actually down about $1 trillion. Okay? The right-hand side shows you that money market assets are up about $1 trillion. So people have taken their money out of the banks and put it into money markets. Why? Interest rates. What are your major commercial banks paying on savings accounts? Zilch. Nothing. Absolutely nothing. What are money markets paying? 4.5%, 4.75%, 5%. So we've seen a mass movement of people looking at these safety types of investments. But again, we go back to this idea that you work hard for your money. Shouldn't your money work hard for you? Or easier said, scared money don't make money. This is a really interesting chart that we've put together, which shows you in the different time periods at which cash balances were elevated, right? So we look from 1991, 2001, and 2011. So these are different periods of time in which cash balances were elevated, okay? And what we wanted to show you was, what if you started to invest in those periods of time when those cash balances were elevated? Now, what we're trying to show you are the different scenarios of how you could have, quote unquote, timed that investment. So each of these different bar charts represent an investor that's putting basically $1,000 a month into the market, okay? In each of these different 3 time periods, you're putting $1,000 into the market every single month, so $12,000 a year, right? And then we're showing you what it would be worth 10 years later. But we're slicing it up by the different types of strategies that you could do to invest that money. So the navy blue is, let's say you timed it perfectly, where you invested at just the right time and the market went straight up. Or maybe you invested at the first of the year. Or maybe you invested dollar cost averaging. Or maybe you invested with the worst timing. Or what if you just held it in cash? The one thing that I want to point out here, and I think this is the powerful stat or powerful slide, because it can really address some of the obstacles that people face. Even if you invest at the worst time, in each of these scenarios when cash balances are elevated, even if you invest in light purple, which is the worst time to invest in each of these scenarios, 10 years later, you'll always beat cash. Think about that. Even if you invest at the worst time, 10 years later, you've always beaten what cash has returned. This is a slide to really illustrate to people that while in the short term it may make sense for people to see that 4 3/4 and they just want to play it safe, what we have historically experienced time and time again is that you look out over the future. If you invest at the worst time, you always beat cash. These are examples of slides that we have to help you all connect with your clients, to help you bring the materials that you need to instill the confidence to continue to build and grow your securities business. If you're interested in these materials, just send me an email and we'll get that out to you.